Good morning. I am delighted to be making this presentation to the Finance Summit of Local Government New South Wales. I'm only sorry that I'm making this presentation in Toronto and I can't be with you in Sydney. It is my understanding that I'm the first presenter at the Finance Summit, so I thought I would try to set the stage by going back to first principles on municipal finance. So I've called my talk Financing Local Governments in the 21st Century, Going Back to First Principles. Local governments, as you know, are responsible for providing a wide range of services to maintain the quality of life in your communities. You provide hard services such as water, sewers, and roads, as well as soft services such as cultural facilities, parks, and libraries. And we know that local governments that fail to provide these services will lose their economic advantage. But local governments need adequate revenues to pay for these services and for infrastructure. But the question is, which revenues? And that's what we're going to talk about this morning. In my presentation, I would like to do 6 things. The first thing is to provide some principles and talk about the importance of linking revenues to the expenditures that are being made. Then I would like to talk about municipal finance in Canada and a little bit about some other countries and try to explain how well we link revenues and expenditures. And then I will talk about 3 different revenue sources that local governments use: property rates, user fees, and federal and state transfers. And then I will finish with some final observations. So let's begin looking at linking revenues and expenditures. We can see the person in the slide here bearing this burden of the tax. And what is that person getting for those tax revenues? Well, in this particular slide, they're getting a beautiful park. They're also getting fire protection. The point is that people want to see what they're getting for their taxes. And when we link taxes and services, people are more supportive of paying those taxes. We have some examples of this in the United States, where a number of states have held referenda, or they call them ballot initiatives, to see if people will pay more for transit. So they might ask the question, will you pay another 1% of the sales tax to pay for improved transit in your community? They're very clearly linking the service you're going to get with the tax you're being asked to pay. So when we're talking about linking expenditures and revenues, we actually start with the services that we're providing and then figure out how to pay for them. And what local governments provide is a range of services. And the 4 categories we've put here are private goods, public goods, goods that are redistributive, and goods that have spillovers. So private goods are things where we can identify who benefits from that good or service, and we can charge them for it. Things like water, sewers, garbage, transit. These are things where we know who's using, we can measure how much they're using, and we can charge for it. So the best way to pay for these types of services is through user fees. The next group of goods that we call public goods, or goods that have public characteristics. These are things where we know the community benefits. We have collective benefits in the community, but we can't identify the individual beneficiaries. So in this category, we have police, fire, local parks, street lights. So for example, we all benefit from street lighting, but we really can't identify how much each of us benefits from standing under a street light. So these are goods that are public goods that are best paid for out of taxation. The property tax is one way to pay for these goods. Another is the sales tax. And let me say, these are not all of the services that are provided by local governments. I'm just putting these up as examples. And you'll see some are in more than one column because they can have more than one characteristic. The third group are redistributive goods. These are goods where we're really just redistributing income from high-income taxpayers to low-income taxpayers through social assistance, through social housing, or other redistributive services. And we know that of all of the taxes that are levied, the income tax is the most progressive tax. So it's the best way to pay for redistributive services. The last group are services that exhibit spillovers, or we in economics say externalities. These are services that spill over municipal boundaries. If I'm a local government and I put a museum, for example, in my community, I might expect that people from other communities around us will be coming in and using that service. But I'm only worried about my taxpayers. So how do I pay for a museum that really spills over the municipal boundaries? And the way to do that is through intergovernmental transfers, where, for example, the state government might say, well, 30% of the benefits spill over your boundary, we'll pick up 30% of the costs, you pick up the remaining 70%. So again, there are different services that local governments provide, and the way we pay for them really depends on the characteristics of those services. We can do the same with infrastructure. And just to give you a heads up, I have 2 slides on infrastructure, so these are not the only tools on this slide. So there are some types of infrastructure that are not that expensive. They have a short life, like police cars, computers. Those are things that we can pay for out of local taxes. Some of the larger expenditure items would mean a lot of taxes in any one year for that community. If you were building a bridge, for example, you couldn't put all of that on the tax in one year. But for those types of infrastructure that have a short asset life, taxes are an appropriate way to pay for them. Again, where we can identify the beneficiaries for things like transit and water, we can pay some of those capital costs through user fees. But for large-scale assets that have a long life, where we have trouble identifying the beneficiaries, borrowing is a good way to pay for those assets. Now, that's not a source of revenue. That's a financing tool because we have to pay back the borrowed funds either through taxes or user fees or some other way. But borrowing is a very important tool because it's a very fair tool, an equitable tool, because we're maybe building a bridge that will have benefits for the next 30 or 40 years. So it makes sense to borrow the money today and pay back that borrowing over the next 30 or 40 years. So what we're doing is we're saying the benefits extend over 40 years, we're going to pay for it over 40 years. So that is what we call intergenerational equity. We're matching up the benefits and the costs over the life of the asset. 3 other ways to pay for infrastructure are development charges, public-private partnerships, and land value capture taxes. Development charges are charges on developers on each lot that is related to the growth-related capital costs associated with that development. It could be new development, it could be redevelopment. And it will pay for things like water, roads, sewers. So we're seeing that this development initiated the need for infrastructure, incurred costs, and we're asking the developers to pay for those costs. Of course, in many cases, those developers will pass on the burden of the charges to the new home buyers. But they are the ones who are using the services. Public-private partnerships, a bit like borrowing, is also not a source of revenue to the municipality. Public-private partnerships are a financing scheme because the private sector either borrows the money and needs to be paid back, or they need a revenue stream to pay for the costs that they've incurred. So P3s are generally used for large infrastructure, roads, bridges, transit systems. They need to have a revenue stream if the government isn't going to pay them back. And they need to have measurable results. We need to know that they're getting something for their money. One good example of public-private partnerships is on toll roads. The last one I want to talk about is land value capture taxes. So when a local government puts in a major infrastructure, for example, a transit line, that increases the land values around that transit line. So through no efforts of their own, the landowners see their land values increase. So is there a way to capture that increase in land value through a tax to pay back the investment in the original transit line? And the answer is yes, and that is done in a number of countries to pay for infrastructure. So those are some of the the principles of financing local government. And now I'd like to tell you a little bit about how we finance local government in Canada and a little bit about some other countries. So let me start with a little bit of background first, starting with the Canadian Constitution. So like Australia, Canada is a federal country. We have 3 levels of government. We have the federal government, we have 10 provincial governments and 3 territorial governments, and about 3,750 municipal governments. That number is one that I use because there isn't one source for the number of local governments in Canada, and so I've actually added them up myself. So I would say that's an approximate number of municipal governments in Canada. So the Constitution divides powers and responsibilities between the federal and provincial governments. Local governments are not really mentioned in the Constitution except as being the responsibility of the provinces. So we often refer to local governments as creatures of the province. Well, why are they creatures of the province? Well, the role of the province in local government matters is pervasive. It's not unlike Australia. So provincial legislation determines what municipalities are responsible for doing, what services they have to provide, and what taxes and user fees they can levy. The provincial governments also set the standards for service. It may be water quality standards, it may be highway standards. The legislation in each province says that municipalities cannot run an operating deficit. They have to balance their operating budgets. They can, however, borrow for capital purposes, but borrowing is restricted in most provinces. So for example, in Ontario, in the province that I live in, the borrowing rules say that debt charges cannot exceed 25% of own source revenues. In other words, the principal and interest costs, the debt charges, cannot exceed 25% of the revenues municipalities collect themselves. In other words, it doesn't include transfers, only their own source revenues. And then the province has a role because they give transfers to local governments. They give unconditional transfers. They may be per capita transfers. They may be equalization transfers. And they also give conditional transfers. Those are transfers that have to be spent on the specific function that the province says. So it may be social services, roads, transit, water, sewer, solid waste. Well, what about the role of the federal government? Well, the federal government has a very limited role in the Constitution. In fact, it has no role in the Constitution in terms of local governments. But the federal government does have spending power, and it can spend its money anywhere it likes. And so it does, from time to time, give transfers to local governments in Canada. There's something called the gas tax transfer, which used to be based on its gas tax revenues. A portion was given to local governments across Canada. Now it's just a lump sum transfer that's increased every year by the rate of inflation. But the federal government also provides infrastructure grants. It provides grants for homelessness, and depending on the economy, may provide some economic stimulus grants, as it did after 2008. So I'd like to turn to what municipalities actually do. And it's a bit difficult to do this Canada-wide because there are differences across provinces, but we also have a problem with the data that is not disaggregated in a way that is particularly useful. So I've picked Ontario, which is the largest province, and looked at the division of municipal expenditures for the year 2013. And from this slide, you can see that the largest bunch of expenditures is for transportation, at 23% of municipal expenditure. So that would include roads, transit, street lighting, sidewalks, anything to do with transportation. Another large group of expenditures is protection to persons and property at 18%, and that includes mainly fire and police protection. Social and family services is also 18%, But I have to say this is unique in Canada. Ontario is the only province where the costs of social services are shared between the provincial and municipal governments. This is not true across Canada. So this is a special situation here in Ontario, and one we talk about quite a lot. Environment accounts for 14% of expenditures. That includes water, sewers, garbage collection, and garbage disposal. And then there are other services as well, health and emergency services. And by health, we mean public health. Here we're talking about immunizations. We're talking about making sure restaurants are meeting current standards. We're not talking about primary care in hospitals. Social housing is another local function. Recreation and cultural services, planning and development, and general government, which just includes administration. So municipalities in Canada and in this case in Ontario provide a very wide range of services. So how do they pay for them? Well, the range is a bit smaller when we look at this chart. The biggest chunk is property tax. Property tax accounts for almost 42% of local government revenues. And I would say that this is true across Canada. That number is pretty similar across Canada. User fees account for almost 20% of local government revenues. So that would include fees for transit, water, recreation centers, and those kinds of services. Transfers account for 21%. That would be a lot higher in Ontario than the rest of Canada because of the social service costs. So some of those social service costs are covered through provincial transfers. Then we have licenses and permits and some other revenues that include fines and license fees and other miscellaneous revenues. Now, in some of the provinces, there are other taxes as well. But these tend to be fairly small as a percentage of total revenues. So for example, some cities in Canada have a land transfer tax. I think you call that a stamp duty. These are taxes that usually piggyback onto the existing provincial system, but the cities are allowed to put a little bit more on that tax for municipal purposes. The city of Toronto, where I live, for example, has a land transfer tax. Sometimes there are amusement taxes. There are some cities in Canada that have hotel taxes. In one province, there's a poll tax. Some provinces allow municipalities to levy a vehicle registration tax. That's a particular favorite of mine as a way to reduce congestion. We actually had a vehicle registration tax for a very short time in Toronto, but our mayor did not like it. He thought it was putting a war on the car, and he got rid of it, so we don't have one now. There's also billboard taxes, and in some provinces there's revenue sharing. So a number of the provinces share their fuel tax revenues with their local governments. With the exception of revenue sharing, these revenues are not that significant, certainly not when we're looking at the property tax. So if we were to go back to my original chart about revenue tools matching expenditure responsibilities, what would I say about Canadian local governments? Well, I think I would say that we're relying a little bit too much on the property tax. We have the private goods that I talked about, where we need to have user fees. We have redistributive goods, where they should either be on the provincial income tax or there should be a local income tax. And the property tax should be used for those goods and services in the middle, the services that have public good characteristics. And I think we've taken the property tax and moved it a little bit too far into the user fee camp and a little bit too far in the income tax camp. And we need to make sure that we're using it mainly for those services that have collective benefits. What about the rest of the world? Well, we've looked at some of the experience in other countries, and we find in those countries that have a bit of a British tradition, there's heavy reliance on the property tax. So more than 80% of local tax revenues come from property taxes in Australia, as you know, in Canada, as I've just told you, but also New Zealand, Ireland, the United Kingdom. When we get into Europe, in other parts of Europe, we find that more than 80% of local tax revenues come from personal and corporate income taxes. So when we're looking at Switzerland or Sweden or Germany, there's very little property tax, if any, in those countries, and they rely heavily on income taxes. And of course, they provide a lot of social services at the local level, so it makes sense to match those services, those redistributive services, with an income tax. Sales tax are used mainly by cities in the United States. Not all, but many of them use sales taxes. And Spain is an interesting country because it has a mix of taxes. It doesn't rely on any one tax. Some of its tax revenues come from sales taxes, some from property taxes, some from income taxes, and other taxes as well. So I'd like to turn now to talk about property rates. Now you'll see I use the term property tax a lot because that's what we talk about in Canada, but property tax and property rates, by those two terms, I mean the same thing, so you'll have to excuse me if I go back and forth between the terminology. So the question I want to ask is this a good tax? Is the property tax a good tax? And you'll see a split in this slide. So obviously the points above the space suggest it is. There are a few points below that suggest maybe there are some problems. Why is it a good tax? Well, first, property doesn't move. If a local government puts a tax on property, the property doesn't run away to another jurisdiction. It can't do that. So it's immovable, you have to pay the tax. So that's a good tax because you can count on those revenues. It's also, from the perspective of local governments, an adequate, stable, and predictable tax. The revenue yields are predictable and they're stable. An income tax, when the economy turns down, the tax revenues go down. When the economy is doing well, those tax revenues go up. The same happens with property rates, but it's not as unpredictable as other taxes. The property tax is also a very visible tax. So I often say to people, do you know what you paid in income taxes last year? And they often don't know because for most people who are employed, it's deducted at source and they've never seen the money and they don't know what it is. If you ask people what they pay in a sales tax, well, they may know what they pay each time they go to the store, but over the course of a year, I don't think anybody knows what they pay in sales taxes. But if you ask people what they paid in property rates, they know because they've had to pay it once a year, twice a year, maybe 6 times a year. It's something they know. That makes the tax very visible. Well, as an academic, I think that's great. It makes local governments very accountable. People know what they paid in taxes and they want services. Of course, from a local government point of view, that visibility makes it hard to reform those taxes, makes it hard to increase those taxes, and I'll come back to that point later. The property tax is fair because it is related to the benefits received from local government services. So if you have sidewalks in front of your property, if there's a transit system nearby, that's reflected in your property values. And so it is fair in terms of benefits received. Is it fair based on ability to pay? Well, I could spend my whole time answering that question, so I'm not going to go into it in any great depth. But let me say that the literature has changed. We always used to say the property tax is regressive. It hurts low-income people more than high-income people. The literature is moving away from that and saying maybe it's not as regressive as people think. Sometimes in individual cases it might be, but on average it's not that regressive. The next point is that residential rates are not exported to other jurisdictions. So I co-authored a book a few years ago called A Tale of Two Taxes, where we said that the residential property tax and the non-residential property tax are two different taxes. One, of course, is on residential property, one's on commercial and industrial property. And one of the ways they are different is in terms of their economic impact. A residential property tax is paid by residents in that jurisdiction. A non-residential property tax can be exported. So if I'm a manufacturer of automobiles and you put a property tax on me, I'm likely to put that into the price of new cars, which may be shipped all over the country. So people all over the country are, in essence, bearing the burden of that property tax. So the residential tax is a very good tax for local government because it means those who are benefiting from services are paying. The non-residential property tax may not be quite as good in that sense. The other good thing about property rates is they have minimum intermunicipal competition. So you can imagine with a sales tax or a fuel tax, people might lower the tax in a neighboring jurisdiction to compete to attract business. This happens less with the property tax. So for all of these reasons, the property tax is a very good tax for local government. I've written a lot about the property tax, as you probably know, so I have to think it's a good tax. But actually it is. There are some problems. One is it can be very costly to administer. As you know, you have to identify the properties, find the owners, and assess the value of the property. And sometimes people feel that it's a bit arbitrary. It's not like income taxes where you report your income. Properties don't sell every year, and we have to basically estimate what they would sell for if they sold this year. So there's a bit of arbitrariness to the base. It can be volatile for individual taxpayers. So you could be living in a house all your life, suddenly your community becomes very popular and the value goes up. You've done nothing to your house, the value goes up. The next year, not so popular, the value goes down. So people like some predictability in their taxes, and that volatility can cause problems. The property tax can also be inelastic in the sense that it doesn't grow automatically with the economy. So when the economy is doing well, income tax revenues automatically increase, sales taxes increase. Property taxes are fairly stable. And actually in some places, and this is true in the province of Ontario, when the property values increase, local governments are required to reduce their tax rates to match that increase. And so they can't get more revenues just because the values have gone up. So it's a more inelastic problem. That's not a problem for taxpayers, that's a problem for local governments. So are property taxes enough? Well, in a book that in a paper that I co-authored with Richard Bird called The Political Economy of Property Tax Reform, we reported on property rates in different countries based on data from the OECD. And what we found was no country gets more than 3% of GDP from property taxes. Canada, United Kingdom, the US get close to that, but most countries get less than 1% of GDP. And we have 22 countries there. So it's a good tax. Economists think it's a good tax, but it doesn't bring in the revenues that people need, that local governments need. In that paper on the political economy of property tax reform, we also looked at reforms in different countries and some of the issues around reforms. And one of the things we found was it's very hard to increase or reform a tax that's visible. So I said to you before, people know what they're paying in property taxes. If you change that, they know it and they can get upset. It's difficult to shift burdens onto residential properties. So any tax reform that means business property rates are going to go down and residential are going to go up, politically is very difficult to do because it's the residential taxpayers who are the voters. Taxpayers need to have confidence in the valuation process, so the whole system has to be understandable, transparent, and perceived to be fair by taxpayers before you can reform the tax. I think you need to know the impact in advance so you can prepare for it. You can't just implement a change. You need to have some sort of phase-in or tax deferral, but these need to be kept simple. And one of the things we found in looking around the world is that when countries or cities bring in property tax reform, the phase-in mechanism is so complicated that they often don't realize that they're hurting the people they're trying to help. There can be unintended consequences. So we have to be careful about how we do that. And lastly, we find that when we link property tax rates to broader reforms in service delivery, again, when people see they're getting something for that higher rate, they're happier, never happy, but happier, less unhappy to pay it. So let me turn quickly to user fees and make the point that we need to price services correctly. This is not just about raising revenues for local governments, because how we pay for services affects our behavior. It affects how much water we consume. It affects how much garbage we generate. If we price services correctly, people will make the correct decision about how much of that service to use. Pricing also affects the kind of development we're going to get. If we have developments close to existing services, it's cheaper to provide services to those developments. Those that are further away, perhaps in a sprawl development, are more expensive to service. But if we charge them both the same, as we often do, we're in essence providing an incentive to sprawl. So we need to price services correctly, not only to get the right amount of service, but also to affect the way our local government jurisdictions look. The last topic I want to talk about is federal and state transfers. So I want to talk first about equalization. Why do we need equalization? Well, some local governments are unable to provide an adequate level of service at reasonable tax rates. That's the objective. That all local governments should be providing comparable services at comparable tax rates. Why can't some of them do it? Well, in some cases, the costs are higher. So you might be in a big city, for example, and the wage costs are higher. You might be in a remote area with long distances to get people to the services, or you need to provide roads, so the costs may be higher. The needs may be greater. If you're a poor community with a lot of low-income households, you may have to provide some other services that a richer municipality doesn't have to provide. And your tax base may be smaller, so you may be providing the same services, but you have a smaller tax base to do it. So equalization allows local governments with a relatively small tax base and high needs or costs to provide a comparable level of service at comparable tax rates. So equalization is important, and as I talked about earlier, grants to address spillovers across municipal boundaries are also important. But there are some buts here, there are some problems. One of the things that transfers do is they break the link between those who benefit from services and those who are paying for services. So a federal transfer means everybody in the country is paying for people in one community to enjoy those services. We've broken that link. Transfers are often not a stable and predictable source of funding. It really depends on the resources available to the federal or state governments, how much money you're going to get from year to year, and it can change from year to year. There's no incentive to use proper pricing. When you're getting transfers from another level of government, there's no incentive to price services correctly. And as I mentioned before, that's a pretty important thing to do. For conditional transfers, the transfers to address spillovers, they can distort local decision making. So you may have an idea as a local government of what services you want to provide. You're now getting a transfer that says you have to spend the money here. That may not be where you wanted to spend the money, but you're getting the money and you'll spend it that way. And lastly, we have found that there can be accountability problems with conditional transfers when two or more levels of government are paying for the same service. So something goes wrong on the transit system, something goes wrong on the bus. Who do you blame? Is it your local government? Is it your state government? Is it your federal government? So let me conclude with some final observations. Again, I want to go back to that principle, and I've said it many times, but I have to say it one more time. It's important to link the decisions that are made on spending with the decisions that are made on financing to determine whether policy decisions accord with what citizens want. User fees are a good way to fund services where we can identify the beneficiaries. And we talked about services such as water, sewers, waste collection, transit, and roads. Local taxes should fund services that provide collective benefits to communities. It may be property rates, but maybe it's a range of taxes that local governments need. And I did have a slide on why local governments would benefit from a range of taxes, but we've run out of time. And lastly, intergovernmental transfers are an important part of the system, and they should be used for equalization and to address spillovers across municipalities. So that is the end of my formal presentation. I understand that we have a few minutes for questions, and that Local Government New South Wales has prepared some questions for me. I'm going to ask Selina Zhang, who is the Manager of Research and Programs here at our Institute on Municipal Finance and Governance, to pose the questions to me, and I will answer them.
New South Wales local governments are concerned about cost shifting from other levels of government, whereby compliance or service delivery responsibilities are allocated to councils without associated transfers of funding. Is this a concern for local governments in Canada as well?
The short answer is yes, it is a concern for local governments in Canada. Cost shifting can take a number of different forms. In fact, in Canada, we call it downloading or offloading, but it's pretty much the same thing. So it can be one of three things. It can be where a state or provincial government shifts responsibilities onto local governments, specific services. So it may decide that it was paying for transit, and now the local governments will do that. A second form of cost shifting is increasing the standards of service at the local level without any additional money. So for example, a state government could impose higher water quality standards on local governments but not provide any funding to go with it. A third form of cost shifting, which wasn't really asked in the question, was when federal or state governments cut back the funding on their own responsibilities. So for example, if the federal government is responsible for immigration settlement and it cuts back funding on those services, a lot of that ends up being funded at the local level because local governments have to provide other social services they may not have otherwise had to provide. So cost shifting takes all of those forms. If we turn to the shifting of services onto local governments, through the 80s and 90s in Canada, a lot of provincial governments went through local services realignments with their local governments. And I can talk about one in particular, which was the province of Ontario in 1998, where the province took over the funding of elementary and secondary education, which had been previously shared between the province and school boards, and downloaded social service costs, social housing, some transit funding, other services onto the local level. Now, this realignment was considered to be revenue neutral in 1998. Some people question whether that was true or not, but let's, for the sake of argument, say it was revenue neutral in that year. One wouldn't expect that it would stay revenue neutral over time. So, for example, social housing was downloaded onto local governments, and at the time it wasn't in a very good state of repair. So over time, those costs escalated. Some people have argued that given the changing demographics, we've had declining enrollments in schools, and perhaps the education costs that were uploaded to the province actually fell. So again, if it's revenue neutral at a particular point in time, it's not going to be revenue neutral as the needs change in the future.
Local governments are, of course, always keen to increase federal and state funding. Could you tell us what you've observed about why they can or can't achieve this, and perhaps give us some examples?
Well, as I mentioned in my presentation, there are two main reasons why federal and state governments should provide transfers to local governments. One was equalization, and the other was spillovers. And these are very important and valid reasons. What I have observed, however, is there can be a number of problems with transfers. The first, and I think I said this before, federal and state funding tends not to be very stable and predictable. The amount of transfer really depends on the state of the finances of the federal and state governments. Are they in deficit? Are they in surplus? And funding often responds to political considerations rather than economic considerations. A second thing I've observed is that conditional grants, for example, grants that are earmarked for roads or some other local service, can distort local priorities. Quite simply, if you're receiving a grant that has to be spent on roads, but your priority is transit, you're probably going to build more roads because you have more money to do that. That should be your decision, which you should be paying for. Lastly, we have found that there's more accountability and greater efficiency in service delivery in a system where those who decide where the money is going to be spent are also those who are responsible for levying the taxes and fees to pay for them. So yes, transfers are a good idea. Federal and state grants are important, but I guess what I'm saying is we have to be careful what we wish for.
In your presentation, you focus on a range of ways that local governments can raise additional revenue. Have you come across any good mechanisms that central governments can use to address unequal revenue-raising capacities in the same jurisdiction or across jurisdictions?
The general approach to unequal revenue-raising capacities is to provide equalization. based on the ability to ability to raise revenues, and in some cases, the need to make expenditures. It's my understanding that the Australian equalization system attempts to do that, more or less. Equalization is not common in the US, however. We don't see very much there. In Canada, some provinces make equalization payments to local governments, but not all of them do. Some provinces use a system similar to Australia's that's based on ability to raise revenues and the need to make expenditures. Other systems are used as well. Ontario does something a bit different. It only gives transfers to rural and northern communities. And in our context, of course, northern municipalities are the remote municipalities. These communities are considered to face more challenging circumstances than other communities in the province. So the transfers only go to those northern and rural municipalities. The transfers are based on a Municipal Fiscal Circumstances Index, MFCI, which attempts to measure the fiscal health of communities and provide more money to those with poorer fiscal health. They use 6 indicators to reflect fiscal health: the size of the tax base, which in our context, like yours, is the property tax base, median household income, the employment rate, the ratio of the working age population to the dependent population, and the percentage of the population above the low-income threshold. The first 2, the size of the tax base and median household income, are more heavily weighted than the other 4, but they're all attempting to measure the ability to raise revenue and the need to make expenditures.
Your final slide talks about the need for policy decisions to be aligned with what citizens want. Could you give us some examples of how high-functioning councils achieve this?
Well, I guess what you're really asking is, how do we know what people want? How do we find out what people want? One way to do that is through referenda or ballot initiatives. And I talked about those before, where many US states use ballot initiatives to ask people if they'll pay more taxes for transit. And many of these have been successful at allowing those local governments in those states to raise taxes. We tried a similar referendum recently in metropolitan Vancouver for transit, but I'm sorry to say that it failed. But I am told that very often you have to try more than once to be successful at these referenda. But another way to find out what people want is to charge user fees. I go back to pricing. When people know the true cost of the service they're consuming, they'll know how much they want and are willing to pay. Let's look at water, for example. If we pay for water out of property rates or some other general revenue, people do not know the added cost of letting that tap run longer, of washing the car more frequently, of watering their lawn every second day. But when we pay a fee that reflects the marginal cost, the cost of an additional liter of water, then people will decide what they want based on what it actually costs to provide that service to them. And the evidence suggests they'll actually use less water if they actually pay the true cost of water. The same is true of road tolls and other pricing mechanisms. So that ends my presentation to you today. I've enjoyed speaking with you, and I do hope you enjoy the rest of the summit. Thank you.